Good evening, everyone. I'd like to welcome you on behalf of Clark County Credit Union to our Becoming a Homeowner webinar. My name is Ryan Lopez. I will be presenting today. Um, I've been in the mortgage industry for about 22 years now, or as I like to say, nearly a quarter of a century. In that time, I've closed about 800 million in loans. A little bit more information about me. I'm a Las Vegas local. I was born and raised here. I attended Bishop Gorman High School and UNLV. So I've seen the ups and downs of the Las Vegas market that whole time. I started in mortgage when I was about 20, and I was fortunate enough to have the manager of the department was more or less my mentor, and he taught me all the ins and outs of the mortgage industry and real estate in general, from buying a home to buying investment properties to developing land and constructing all those kind of things. And with his help, I was able to buy a home at the age of 21, like a year after I kind of seriously started working. And can anyone hear me okay?
I can hear you, Ryan.
Yeah, we
can
can
Okay.
hear you.
Perfect. Someone said that they couldn't hear me, so I just wanted to be sure. so anyways, I bought my first home when I was 21. By the time I was 28, I owned 3 homes, and so I strong. Is something everyone, homeownership is definitely something everyone should strive for. And I'm hoping that I can help you on your journey to buy a home a lot like the mentor that I had helped me. So, during the presentation, we ask that you keep your mics muted. At the end, we'll be going over any questions. If you have questions during the presentation, feel free to type them in the chat, and we'll go over all of that. And we'll be sending you a copy of the presentation along with any notes you might have, so you can go over all that information. So with all that out of the way, let's get started. So positioning yourself for home buying. So, home buying, especially your first time home ownership, can be exciting, but it can also be a little bit scary, But if you look at the slide here, you can see that there's definite steps you can take, and it's not so daunting, if you kind of break it down and go over everything. So just to kind of, go over these quick steps here, we're going to break these down kind of one by one as we do the presentation. But you've got saving for your down payment and other costs, addressing your credit report and scores, getting pre-approved, choosing a realtor, searching for the property, selecting the property you want, submitting your offer on that home. The offer gets accepted, then you enter into pre-closing, or what we call escrow a lot. Then you'll sign all your paperwork, get your keys, the ownership is recorded, and then you can move into your new home, and you're officially a homeowner. So now we're going to break down some of those steps, right? So step 1, saving for home ownership, right? There's a couple of different ways, things you're going to have to save for, just considerations. Down payment is probably the largest one that is going to be the focus of what you need. A lot of people are still under the, misinformation that you need 20% down to buy a home. On a conventional loan, you can do less than 20% down. You can do as little as 3% down if you're a first-time homeowner, 5% down if you're not. FHA allows 3.5% down. VA will allow no money down. So there's just those kind of different programs and what they look for. Other things you'll have to save for would be closing costs. You're also going to have any post-purchase reserve funds, depending on the type of loan that you're doing. The lender may require that you have some reserves, and basically what that is they may want you to have 1 or 2 months or 6 months worth of payments, depending on the type of loan you're doing. It's not always required, but the more reserves you have, the stronger your loan is. And then, things that come up after closing that you want to consider. Any repairs you might want to make, renovations to the house. I always say it's funny because you'll spend all this time looking for the perfect house and you'll search and search. And then once you find it, the first thing you're thinking is like, okay, let's change everything. Let's paint, let's change the flooring, all those kind of fun things. Plus, there's also, furniture, appliances for the home, those things that come up. So ways to develop savings. So one way is, regular savings. You want to, set aside some money. The sooner the better. That way you can start slowly putting together the funds you're going to need. One way that's kind of often overlooked is 401k. 401k can be a big help in helping you buy a home. Sometimes people, who aren't participating don't think about it that way, but you can, withdraw money from a 401k to purchase a home. Or if you can't withdraw the money, you can even get a loan. And the loan doesn't count against you for qualifying. So those are different things that you can do with your 401k that help. Plus, since a lot of 401ks allow for your employer to contribute, X amount into it on your behalf, it's kind of like getting an extra, 3% raise a year or whatever their contribution might be. The other possible ways to develop savings are gifts. You can get gifts from family members. You can also get gifts from a fiance or a close friend, but we've got to prove that relationship. The gifts can't be a loan because loans aren't permitted to get financing. So you can't use loans for down payment or anything along those lines. The other thing that people sometimes don't think about is that you can actually sell assets to, use those monies for down payment or for closing costs or whatever it might be. If you have collectibles or jewelry or vehicles, you can sell any of that and use that. Everything just has to be documented with a bill of sale. Sometimes we'll need a valuation to make sure, but had a young man purchase a home, and he had a sneaker collection, and the source of his down payment came from selling, a couple of pairs of sneakers. He sold like 5 or 6 pairs, and that's how he bought his home. All right. So another important part of getting a home loan is your credit report and your scores. Credit scores are an So credit scores are important because the better your score is, the easier it's going to be for you to get pre-approved. It's going to make your loan go smoother, but you're also going to be able to get better terms. You'll get better interest rate, lower closing costs, and of course, the better your interest rate, the more home you can qualify for. So, interest rate goes a long way, and your credit scores affect all of that. However, if you don't have great scores, don't let that stop you from, moving forward and applying. A lot of times, if you apply, a loan officer can look over your situation and kind of advise you on what you might be able to do to improve your credit scores, depending on the program you're looking for. They all have different requirements. So, FICO scores typically range here from 300 to 850. The higher, the better, naturally, right? Many mortgage lenders require a score of at least 620, but that's on a conventional loan. FHA will let you go down to about 580. And VA, it depends on which lender you're going with, but a lot of times they hover around 600. Some of them will go to 580. You want to check your scores, in advance of applying. Have an idea of where your scores are sitting at. When we do a mortgage pool, we're required by the government to pull all 3 credit bureaus. So we have to pull Equifax, TransUnion, and Experian. So be sure if you're checking your scores that you're looking at all 3 of them, because if you only have one, that could be your highest score, and that could be completely different from what we end up looking at. All right, so part 2 of addressing this is tips to raise your FICO score, and there's a good amount, some that people don't even think about sometimes. So of course, number 1 is make your payments on time. You're getting a home loan. The number 1 thing they want to make sure of is that you've been making your payments on time. They don't want anything that shows over 30 days late on your credit report. 60 or 90 days late starts to get into red flag territory. So definitely watch out for things like that. 2 of the big components that make up your credit score, the 2 largest factors, are payment history and how much of your credit are you utilizing. So this is where you kind of hear where if you have a revolving credit line, like a credit card, for example, and you have $1,000 balance, you don't want to be maxed out. You want to be 50% or so under the limit. So keep your balances around that mark. So a lot of people will tell you to pay down those balances, and that definitely helps because paying down those balances reduces your payment, which also helps with your debt to income ratio. But paying it down under that 50% will boost your score. Another way to go about getting to that 50% mark that sometimes people don't think about is to request a credit limit increase. So you can actually, call whatever creditor and ask them to increase the limit on your revolving line of credit. And if that helps you get to that 50% mark, then that, accomplishes the same thing as well. You want to keep older revolving accounts open. So if you've had an account for years, even maybe if you don't use it very much, but you've had the account for, 4, 5, 10 years, or whatever it might be, don't close it, because one of the components of credit is how long you've had credit. And if you've got a bunch of new credit that hasn't had a long history, and you close this long line, this long history you've had, that can adversely affect your score and actually make it go down. So sometimes people think like, oh, I don't use those accounts, so I'll just close them. But you're actually hurting your score a little bit there. Limit any credit applications, of course. Sometimes, especially around the holiday seasons, we'll see people who are out, shopping for the holidays, and maybe you'll get an offer from, whatever department store you might be at, where, hey, if you apply for this credit card, we'll give you, 20% off or 15% off or whatnot. And if you go and do that, all of a sudden you have a credit score inquiry. And it's not a major hit, but it can ding your score 5 points. Then we'll also have to, explain, what was that inquiry? Did you actually open that account? What's the payment? All those things. So that can hurt, Other things you can do to bring up your score. We see a lot of people self-reporting utilities. Utilities usually aren't factored into your credit score, but sometimes people have a super long history of paying, rent, insurance, gas, electricity, water bills, whatever that might be. You can self-report those items, and that history could actually help to bring up your score. We've even seen people reporting things like Netflix, and everyone seems to have that, so that can help some. And that kind of factors into that last section there where they're talking about non-traditional credit scores. If you don't have a credit score, it's better than having a bad credit score. So we can actually work with you if you have no credit or credit history. We run into this sometimes with, college students that are maybe graduating from college and haven't really had any credit in their name or those kind of things. We can build what we call a non-traditional credit score, where we'll factor in what your rent history has been, what your insurance history has been, utility history. But even if you can't do that, sometimes what you can do to offset or help out with a credit score issue is you can get what's called like a non-occupant co-borrower, which is essentially getting someone to co-sign for you. They're not going to live in the home, but if you have a parent or a family member who's willing to co-sign, sometimes that can help with not having a credit score or having a weaker credit score. All right, so now we're getting on to getting a mortgage loan and how that all works. What's the difference between getting pre-approved and pre-qualified? You'll hear those terms kind of tossed around sometimes by realtors. Did you get pre-approved? Have you been pre-qualified? There's a slight difference between the two. Pre-qualified might be, someone calls me on the phone and they say, Ryan, I make, $5,000 a month. How much do you think I could afford? And I might be able to sit down and kind of do a rough calculation, say, payment-wise, you'd be in this range. But there's no commitment there. There isn't any, because we haven't done any verification. So we don't really know if the income you gave me is correct or what do your other debts look like or any of that. So that's where pre-approval comes in. Pre-approval essentially is, completing an application. We're going to look at your credit score, the debts that are showing on your credit report. We're going to look at, the assets you have. What does your employment history look like? What does your income look like? All those things factor in. We talked about credit score. Assets, again, comes into play for, we want to make sure that if you're buying a home and everything, you can actually close it. Your credit score might be fine. You might make enough income, But if you don't have the funds to come up with at the end for the down payment or your closing costs, then, we can't make that loan work. So that's one of the things they're going to look at. Employment history is critical. You're required to usually have a 2-year employment history, but it doesn't necessarily have to be in the same line of work. A lot of people think you have to be in the same line of work or even the same job, and that's not always the case. However, if you change jobs a lot, or if the type of pay that you're receiving has changed, like maybe previously you were salary, but recently you went to a new job in the same field of work, but it's hourly, but maybe your hours fluctuate, that can kind of have an adverse effect on your income calculation. So there's things like that you'll want to talk about. If you're thinking, if you're mid-transaction and getting pre-approved and maybe you get an offer for a new job, we generally suggest that you hold off on that, but talk to the loan officer, because if it's better, a lot of times it'll help you out, but we can also kind of advise you on what to look for that could affect your loan negatively. Income and existing debt kind of go hand in hand. We're going to want to look at your income, see how it qualifies, and of course we need to make sure that you can repay the loan. If you're a salary borrower, pretty easy calculation. If you're an hourly borrower, a lot of times we're going to average. Here in town, of course, we have a lot of tip earners, so we go by the tips that are reported. So if you don't report your tips, or you only go by whatever the employer reports your tip as, that's what we're going to use, and they're usually going to average those tips over the last 2 years. The same goes for like overtime or any bonus pay, anything that's not like base pay, like hourly wage or a salary. If you're self-employed, then we're traditionally going to want a 2-year history that we can verify with your tax returns to give that all a look, see how the business is tracking. Is your self-employment business going up? Are you earning more income every year? Or do you have declining income where the income's going down? So those are the kind of things they're going to look at. And existing debt is also important, because this is where they call, this is how we qualify to make sure you can afford everything. A lot of times people say, well, how much do I have to earn to be able to afford a price of this house? And the answer that I usually have is, well, how much do you spend? Because I've done loans for people who maybe they're earning $36,000 a year, and they can qualify for a home just fine because they don't have a lot of debt. On the other hand, sometimes I've had borrowers who are making, $200,000 a year, and they have so much debt that they can't really qualify for anything. So it's things like that to keep in mind when you're looking at. One important caveat here that we see a lot with existing debt when trying to qualify borrowers is car payments. If you're in the market for a new car and a new home, get the home first, because a dealership will find a way to approve you for a car loan. I've seen them do it. I had my ex-wife, right after she graduated nursing school, she wanted to get a new car because we just had our first baby. She hadn't started working yet, but she went to the dealership and told them she had just graduated nursing school, and they just gave her a car. She drove away, keys in hand, at night. That would never happen in mortgage. If you get a car and the payment is large, and a lot of car payments are, unfortunately, it can really affect your ability to qualify. If you have a $600 car payment or a $700 car payment, you have to factor in how much of a percentage of that is your gross, income. So if you have a $600 car payment, that's 10% of a $60,000 a year salary. If you're breaking down a month, 6,000 or whatever it might be. So you have to keep those things in mind. Definitely try and get the house first, because you can get the car later, but it won't work in reverse. The other thing that comes to income is when you're talking to one of the loan officers, we're, of course, this is why we ask for pay stubs and W-2s, because we really want to verify what you're earning. Sometimes people are hesitant to start providing all that documentation that we'll need. And the reason, and a lot of borrowers will say, oh, well, I have direct deposit with you. Can't you just look at my direct deposit? Well, the issue with direct deposit is that what we're seeing there is the net deposit. So we're seeing the income after taxes and Social Security and 401k deductions and health insurance, and all that's been deducted out. When we qualify a borrower, we're going by their gross income. So we want to look at your pay stubs to see what what the total income is, what the maximum income is that we can use to qualify you, right? So then once you've got all that set, we're going to issue a pre-approval letter. That basically says that as long as there isn't any major changes in your finances, you're good to start looking for a home. You'll show that to your realtor. They'll start taking you out. Everything's great. The rate, though, that you have at the time of pre-approval isn't locked in. And that's because when we lock it in, we have to have a property address to lock it into. Everything's automated now. The systems won't even let us do it if we wanted to. So once you find a home and you get the contract, you send it to us, that's when we'll lock you in. And at that time, we'll give you what's called the official loan estimate. Within 3 days of receiving the purchase contract, we're required to send you the official loan estimate, and it shows kind of all the details you're going to want to know for the loan. If you've been around for a long time, the loan estimate used to be called the good faith estimate. The government changed that in 2010. After the housing collapse, they made a bunch of changes to the mortgage industry. That was one of them. The loan estimate shows, the purchase price of the home, how much you're looking at for down payment, has the rate been locked in at that time or not, and if so, how long is that rate lock good for? It has a breakdown of all the costs on the loan, and a lot of those costs aren't allowed to change later. Certain ones can, taxes, insurance, per diem interest, those kind of things that just depend more or less on when you close and who you pick, but a lot of the other fees can't close. So the loan estimate is a good tool. You definitely want to watch out. There are, there are some lenders that we've heard of that, you go, you apply, you get everything turned in, and a lot of times they won't issue the initial loan estimate until close to closing. And that can be a problem because if you're a week or two away from closing and all of a sudden you get your disclosure and the rate and the cost that they told you or the down payment amount changes significantly, now you're kind of in a bind, so you want to watch out for things like that. All right, so now we go on to a popular topic. Everyone always loves this one, down payment assistance programs. There are, various down payment assistance programs that are out there. There's the Home is Possible, there's Wish, there's Chinoa, there's a lot of programs. We have one exclusive to Clark County Credit Union. We call it the Home Now program. It allows for 2% down, which is pretty stellar. As I mentioned earlier, conventional loans usually look for 3% down minimum. FHA is 3.5%. And if you're a veteran, then you can get a 0 down loan, and that's great. In order to use the Home Now program, you have to be a primary resident, so you can't use this program to get an investment property or a vacation home or anything like that. It's a 30-year fixed term, which is stellar, and it has a below market rate. So right now, most rates for a 30-year fixed are at about 7% or so. Depending on your credit, sometimes you can get, 6.5, 6.7, but you're probably looking at about 7 for the average borrower, depending on how much down you put. The rate for this right now is 4.99. So it's a pretty stellar interest rate, fixed rate. It's not an ARM or some sort of 3-1 buy down or temporary buy down that a lot of lenders are using right now. It does have an income caveat, though. The maximum income can exceed more than $81,000, $81,700 to be exact. But that is qualifying income. That's not household income. So what that essentially means is if you have, a husband and wife, and maybe wife makes $200,000 a year, but husband is at $75,000 a year, then if husband can qualify by himself for the loan, then he's eligible. So we could do that program. It's pretty stellar. The loan does require PMI. However, you are allowed to put more down if you wanted to. So, like any loan, if you put 20% down, you don't need to pay PMI. We do allow, and this gets a little complicated, but we do allow for the PMI to be financed into the loan, which actually makes your payment lower. So it allows you to have more purchasing power when you're out for shopping, because that's a big caveat right now. Everyone's out looking for a home, and home prices are high and rates are high. So this program is kind of designed to help people, not have to have too much of a down payment, but also help keep the payment down with a lower interest rate and a lower MI structure to help you, have more purchasing power. This loan does require 2 months of reserves. So they're going to want you to have 2 months of payments in reserve after you pay for your down payment and your closing costs. 2 months of reserves means the total payment, the principal, the interest, the taxes, the insurance, And it also includes the HOA if the property you find has an HOA. All right, types of mortgages. So this can be a little bit overwhelming, especially for first-time home buyers. There are so many different types of mortgages and, variables and all sorts of nomenclature that we use. And they all kind of sound the same too. You've got Freddie Mac, you've got Fannie Mae, FHA, VA. There's all sorts of options, and it can be hard if you don't really know what you're dealing with to know the exact rules and guidelines. That's where your experienced loan officer comes in. If you call, any one of us at Clark County Credit Union, we're all experienced to walk you through what will kind of sit best for your situation and kind of help you achieve your home buying goals. When we talk about Freddie Mac and Fannie Mae, those are conventional loans. FHA is, kind of the original federal home loan program. It was created, by Roosevelt after the Depression and whatnot, part of the New Deal. Essentially, at that time, lenders wouldn't lend to someone unless they have a massive down payment. We're talking 50% or more, and it was big. And that basically meant that the average person couldn't buy a home. So what they came up with was FHA. And this is where PMI came into existence. A lot of people give PMI or private mortgage insurance kind of a bad rap. They kind of say, I pay it and it doesn't really do anything for me. It only protects the lender. And, that's true to a certain degree because that's all PMI really does is protect the lender should someone default on their home loan. But what PMI really does is it lets people buy homes without having to come in with large down payments, 20% down or whatever the lenders might be wanting. So while PMI gets a bad rap, historically, it actually helped out a lot of people. And then, of course, we said VA, VA has their own programs for veterans. They're great. I'm a certified VA loan specialist. So if anyone has any VA questions or anything like that, we can talk about that. A lot of people think you can only use an FHA loan once. That's not actually true. You can use FHA multiple times. If you buy a home and it's a starter home, and then later you have an increase in family size and you want to buy a larger home, you can use FHA again. VA is the same kind of thing. A lot of people think that VA can only be used once, or it can only be used one at a time, and both of those are false. With VA, you can actually buy a home. You can still own that home and turn around and buy another home using VA later if you need be. And the reason for that is that sometimes if you're in the service, you might get relocated. Maybe you were serving in Pendleton, and now you're having to go to another, base, wherever it might be. You don't necessarily have to sell the old house you have. You can relocate and buy a new one. VA will even let you refinance the old one, even if it's being rented out at that time. So it's kind of interesting. A lot of people don't realize that's a possibility. So from there, we're looking at, types of mortgages besides kind of the big 3 or 4 government agencies that do that. You've got your fixed rate mortgage, which of course means it's a fixed rate. The interest rate, the payment doesn't change. When we talk about the payment not changing, though, we're talking about the principal and interest. Your taxes and insurance can still go up a little bit with the value of the home. So if the value starts going up, the county is going to charge you more for taxes. A lot of times your insurance is going to go up too. But the same is true in the opposite. If homes go down in value like it did in the housing recession 2008 through like 2012, you'll actually see your taxes and insurance go down. So those are things to keep in mind there. Adjustable rate mortgages, right? These got a really bad rap, during the time that we saw that, the housing bubble burst and whatnot. And it's mostly because they were misused. A lot of people didn't realize the type of loan they were getting into. They weren't explained correctly, and it ended up biting a lot of people. But essentially, you'll start with a lower than market interest rate. It's usually fixed for 3, 5, 7, 10 years, depending. The shorter the term, usually the lower the interest rate is. But after that, the rates start to adjust, traditionally every year. And that's where you hear reference to like a 3-1 or a 5-1. And basically that means it's fixed for the first 3 years, and then every year after that, it's going to change. the most important thing is that that rate can go up on you quickly after the initial time, and then you may not be able to afford that payment if you didn't plan ahead. So those are the things to keep in mind with ARMs. ARMs aren't terrible loans as long as you know what you're getting into and you kind of strategically think about why you're doing it. Like someone who perhaps is going to see a large increase in income in a few years might consider an ARM, perhaps a medical student or a law student. At the time that they're in med school or law school, they might not be having the kind of income that they intend to receive once they graduate. And that's the type of person that an ARM loan might be good for. Or if you don't intend to keep the loan for a long time, again, perhaps a military person or someone who has to move around often for their job, they might not, why take out a 30-year loan if I'm only going to be in this home for 5 years or whatever it might be. And then other type of loan that we have is an interest-only mortgage. This is probably the most risky one that's still available. There are other more risky loans, but they aren't really available anymore. Interest-only mortgages a lot of times are also ARM loans. A few of them can be fixed, but those are much rarer. We don't really see a whole lot of those. The low payment, starts at the beginning. It's only interest, and you usually have that teaser ARM rate. But what ends up happening is once that ends, not only does your interest rate go up, but at the same time, now you're having to pay principal, but it's over a shorter term now. So maybe you took out a 30-year, but 3 years have gone by, so now it's down to 27 years, and now the principal gets amortized over that remaining 27 years, and it makes the payment kind of spike, considerably. So those are the things to consider because that payment can really jump up fast. Now, both adjustable rate ARMs, and interest-only ARMs do have the possibility of going down. A lot of people think they only go up. They can go down as well. So if rates, start to weaken in the future, they can actually go down. And when they adjust, you can actually end up with a lower payment. People who had an ARM, prior to 2008, rates started to go up maybe, but as years went by, rates started to really plummet. And if you had a loan during that time period, your payment probably just got lower and lower. So it's kind of an interesting thing, but that's not always going to be the case. So you have to watch out for it and plan ahead. All right. So now we're going to talk about closing costs. We talked about down payments, the amount you have to put down to get the home. Closing costs are basically the fees. Getting a mortgage isn't free. Not only, once you have the mortgage, you're going to be paying interest every month, but when you get the mortgage, there are a ton of people involved, a bunch of different companies that need to participate, and they all have fees that they charge for their services. So you have the origination fee is essentially what the lender charges. This is their cost, some places offer no origination fee, but a lot of times what you're seeing there is that they'll have higher interest rates. The same goes for any company that markets that they have no closing costs. A lot of times the trade-off there is a higher interest rate. A lot of times we like to say that interest rate and closing costs are the opposite sides of the same scale. And if one goes up, the other one goes down. And if the other one goes up, the other one goes down. And that's kind of the way it works. So when we come into points, for example, points are what you'll pay to get a certain interest rate at times. Not all loans have points. There are, loans that are at what we call a par rate, and that would be a rate without any points. So in those situations, usually 1% or 1 point is equal to 1% of your loan amount. So if you have a $100,000 loan and you pay 1 point, that's $1,000. Now, a lot of people think that 1 point translates to a 1 point reduction in their interest rate. So if I pay 1 point, that's going to lower my rate by also 1 point. That's not the case. You might pay 1 point, and it might only lower your interest rate 0.25% or 1/8, 1/2. It just depends on the market for that given day, and the market's always changing. The points on one day can be different from the points on another day for the same rate, just depending on the stock markets and all those things. So there's a lot of variables there. On the other end of paying points, there's also what we call lender credits, which is essentially if you have your par rate, which is kind of at 0, no points, and then you have discount points that you're paying, which is to get a lower interest rate. On the other end, you have lender credits. where now you're taking a rate that maybe is a little bit higher, but it's going to credit your closing costs. So it's going to be a deduction on your closing costs. And so that's what we talk about that analogy. Like if your rate goes up, your cost can go down. But if your costs go up, your rate can go down. So the good things to keep in mind, especially in this market, the market's softened up a little bit. It's not quite as strong as a seller's market as it was, and it's more of a buyer's market now. So you can get, the seller to pay some closing costs. If you go with like Clark County Credit Union, our closing costs are relatively low. A lot of other companies, big banks, and especially brokers kind of have the most expensive way to go. A lot of times their cost will be like 3% of your purchase price might be. So if you're buying a $300,000 house, you're looking at about $9,000 in closing costs, which is a ton. And the bigger the house, the more the costs are because you're paying points and those kind of things. Our costs tend to hover, just depending on the loan and the taxes and insurance you get, usually somewhere between like $5,000 and $6,000, unless you decide to pay points. So it's things like that you want to keep in mind, because if the seller is paying, let's say 2% of that $300,000 purchase price, that's $6,000 that covers your cost. If they pay more than that, if they pay $7,000 or $8,000 towards your closing costs, that difference can be used to buy you a better interest rate. So those are things to keep in mind there. In terms of other costs, you have the title company. The title company is kind of like a disinterested third party between the buyer and the seller. They're going to make sure that everyone's represented accordingly. Everything gets done according to the purchase contract. They're going to, hold the earnest money, deposit money, and handle the title search and all those kind of things. So they charge fees for that. They have their escrow fee and their title insurance. The title insurance is basically what is going to insure the home buyer against any previous lien that might be on the house that you didn't know about. And it's rare, but sometimes things pop up. For example, perhaps the seller of the home had someone come over and do work. Maybe they had a plumber or a carpenter or someone come and do some work on their home. And for whatever reason, there was a dispute between the two of them, and the seller of the home refused to pay them. He turns around and sells the home. You purchase the home, and then afterwards, the mechanic, the carpenter or the plumber or whoever it was, he files a mechanic's lien, and that pops up on the title of the house. Now, that wasn't anything that you owed that contractor or whoever it might be, but he's due his money. If that happens, usually this is where your title insurance will come in and cover that claim for you, so you don't have to worry about it. So they're going to ensure you have clean title, that nothing can pop up. And usually all of that stuff is cleared prior to closing, but there are occurrences where something like that pops up that maybe it was in the process of being filed with the court or whatnot, and it didn't appear until after closing. So that's where that comes in. The appraiser, right? You want to make sure the home you're buying is worth what you're paying for it. If you're buying a $400,000 or $500,000 house, you don't want to buy it and later find out it was only worth $350,000 or $450,000 or whatever, whatever the price might be. So the appraiser is going to go. He's going to look at comparable sales in the area and compare it to the home you're buying. He'll look at usually at least 3 houses and 2 listings to get an idea. And he's basically going to say, well, this home has the same square footage of this home and it's sold for X. But then he'll factor in some other things. You might say, like, well, that home had a pool, though, and this one doesn't. So he'll subtract and add based on the features that the home has. It's a good thing to get. You want to make sure that, the home is worth what it is. However, sometimes you don't always need an appraisal. VA, FHA always want an appraisal if you're purchasing a home. On the conventional side, you can get what's called an appraisal waiver. Fannie Mae and Freddie Mac have a lot of statistical data on homes and areas from all the loans they're doing. So sometimes, depending on the home, depending on the loan, those things, Fannie Mae and Freddie Mac will look at the property and they'll look at maybe the purchase price or what we're estimating for the value, and they'll come back and say, we're good with that estimate. We don't need an appraisal. At that point, you can still opt to get an appraisal if you wanted to, just to make sure. But usually it's a pretty safe bet that the home is worth what it's worth at that point, because Fannie Mae and Freddie Mac wouldn't be offering to waive the appraisal if it wasn't. But that does save you whatever the cost of the appraisal is if you're lucky enough to get that. Now, the survey, usually also done by title, they're going to come out and check the property boundaries. and, look into those kind of things. You're going to make sure that everything's correct there. I had an issue on a loan once, not my personal loan, but a loan I was working on, where the owner of the home that was being sold lived next door. And so they were selling the home, and as we're working on all the title things, they do the survey, and they find there is a dispute over the property line. And so then title was working to figure out, what the dispute is or what's going on and what's happening. And meanwhile, the seller that lives next door is, in a hurry because they want to close right away, but we can't close until we get this property boundary issue resolved. And it turns out the dispute over the property boundary was actually filed by the owner that lived next door. So, it's kind of an odd situation because he was causing the delay, but didn't want to own up to it, which is kind of a funny thing. Recording fees, the county charges a recording fee for the home to transfer from the seller to the new buyer. The recording fees, traditionally on a resale home, they're paid for by the seller, but that's all negotiable. So while that is traditionally the case, it just depends on how your contract is written up. One of the things that you will see come up if you go buy like a new home, like if you go to KB or you go to Pulte or Lennar or Tolbro, any of the builders, they pass a lot of their traditional seller costs onto the buyer. So not only is a new home, more expensive to begin with because it's new, and that's kind of the premium. It's like buying a new car. It costs more than a used car because it's new, and you get to pick out the features you want and everything. But they also pass on a lot of their costs to the buyer, and a lot of times they will say like, oh, if you go with our in-house lender, we'll waive all the costs and whatnot. And in those scenarios, a lot of times what they're doing is either increasing the price of the house to absorb that, or they're giving you a higher interest rate. And a lot of times that's what you're looking at. So you want to be savvy. And a lot of times people don't know to check or look or shop around. So it's always good to do that. While we're on the subject, if you're going to look at new homes, bring your own realtor with you. A lot of people don't think of doing that, but when you go to look at a new house, everyone in the sales office, they're all realtors, but they all work for the seller. They work for the builder. So they have the builder, the sellers, finances and profits in mind. They're not really representing you. If you go with your own agent, a lot of times they can help you negotiate some things, negotiate costs, or negotiate you using your own lender instead of their lender, all those things. And some people don't think about that, and it's a good thing to do. And then, of course, the last thing you have here is mortgage interest. When you close on the loan, you always skip the following month's payment. So, hypothetically, it's October. Let's say we were closing on a home right now. It's the 20th. You're not going to have a payment due in November. Your first payment will be due in December. And a lot of people think like, oh, that's great, I skip a payment. But the reason you skip that payment is that mortgage interest is always paid in arrears. So that December payment you're making actually covers all the interest for November. And that's the way mortgage interest works. That's why when, if you currently have a home or if you've ever had one before, your loan balance might show a certain amount, but when you get the payoff, they always tack on a pretty significant amount of interest, usually a month's worth, because the interest for that month that you're paying the loan off in hasn't been paid yet. So, they always get their due. With that being the case, hypothetically, if we close now on October 20th, December's payment pays all of November's interest. But if you acquire the home on October 20th, you start accruing interest immediately. So, all the remaining days in October have to be paid for, and that gets added to your closing costs. So right now you would have approximately 10 days of interest, from now to the end of the month, and that's usually how it's counted. That's why most people tend to close at the end of the month, because if you close, on the 25th or the 30th, you might only have 5 to 3 to 1 day of interest. Whereas if you close at the beginning of the month, you're going to have 30 days worth of interest, and that's a lot more. But if you close at the beginning of the month, you get to skip 2 payments. So it just depends. All right, so mortgage payment components, right? You're going to have your loan, and you have to repay the loan, and part of that is the principal. So on your mortgage, coupons that you'll get every month once you have the home, you're going to see the breakdown of what constitutes your payment. The principal is what pays off the balance. And you'll notice that the principal that you pay at the beginning of the loan is very small. It's hardly anything. The interest is going to be the majority of the payment. So, you're going to have a lot of that. It's going to go down a little bit with each payment you make to the principal, but very small. You'll usually only see the point where principal starts to exceed interest. It usually happens around year 10 or so. So you have to be 10 years into the loan before the principal you're paying each month even starts to be larger than the interest you're paying every month. And that's due to what we call the amortization mortgage. So if there's a 30-year loan, you pay more interest. If you do a 15-year loan or a 20-year loan, then that, cuts down on the amount of interest you'll pay. For example, just to give you kind of round figures, if you take out a $100,000 loan over a 30-year, you're going to end up paying about $150,000 in interest. It's usually 1.5 times in interest than what you took the loan out for. Whereas if you do a 15-year loan, it's going to be a very nominal amount of interest because you're paying the principal down so aggressively. Now, one trick here that's always important, which I always counsel all my home buyers, right, is if you can, when you have it, pay extra principal, especially at the beginning of the loan, because that's when it's going to make the most significant, impact on your mortgage. You'll hear a lot of people say, "Oh, if you make biweekly payments, then that can cut down the principal faster," and that is true. But it's not really because you're making biweekly payments. It's because you end up making, 26 half payments, which is 13 full payments. So essentially, if you make one extra payment a year, on average, your average 30-year loan, you'll cut about 8 years off of that amortization, and you'll pay off the loan 8 years earlier. So it's always kind of nice to consider, and the higher the interest rates are, the more effect that has. So in this market, it's definitely something to consider when you have it. If you get a bonus at work, toss some money towards that principal. If you get a tax refund, toss that money towards the principal. Anytime you can, any little thing like that to go a long way. And you just factor it out so it's not as big of a hit. If you have let's say you have a payment that's $2,400 a month. If you divide that by 12, that's $200. You just pay $200 extra every month to the principal, and that's going to cut down on that principal or the interest that you're paying, and help you pay off the loan faster. So that's kind of a great way. The other things that are included in your payment, besides the principal and the interest, is your escrow payments. If you're putting enough down on a conventional loan, you don't have to escrow, but most people do. It's just convenient. Property taxes are included in your escrow. The homeowner's insurance, if you have mortgage insurance, it's included in there. And it just kind of makes things a little bit simpler, especially with the way our property taxes are handled here. Clark County collects quarterly payment installments, but they don't collect it at quarterly intervals. So it gets a little crazy. The first quarter's taxes are due in August, and then right after that, they're due again in October. And then you don't have a payment due all the way until January, and the next one in March. So you can see where those intervals are kind of all over the place. And then after March, the next payment's not due all the way until August. So it's kind of weird. If you impound all that stuff, the lender is going to collect a little bit each month to make sure that when the taxes come due or your insurance comes due, we'll pay it for you, and you don't have to worry about it. Because you don't want your insurance to lapse. If you do, that can be a problem. Sometimes people just forget, and then the lender will put what's called forced-placed insurance on the home, which is a lot more expensive than the regular insurance you can get from any provider you wanted. It's like your car insurance. If you don't have car insurance, the DMV finds out, they send you a nasty letter, all those kind of things. NPMI, private mortgage insurance. If you don't put 20% down on a conventional loan, you have to have mortgage insurance. Now, if you do end up needing mortgage insurance can be removed automatically when the loan reaches a 78% loan to value ratio. So basically what that means is if you bought the house for $100,000, just because it's a round number, right? And the balance based on your original, value of the home and the original purchase price, the balance gets to $78,000, your mortgage insurance automatically goes away. You don't even have to do anything. But that's only based off of the original purchase price of the house. It doesn't take into consideration current valuation, right? So if that home you bought for $100,000 goes up to $200,000, well, guess what? Now you're at 50% loan to value. You don't need your mortgage insurance anymore. However, in order to drop it based on current value, you have to request for your lender to do it. And it's kind of based on lender discretion. The lender can agree to drop it or not drop it. So it just kind of depends on where you're at there. Traditionally, in order to drop it, you can't have any late payments on your mortgage in the past and things like that. FHA is different. FHA requires mortgage insurance for most loans for the life of the loan. Mortgage insurance, and I explained this a little bit earlier, but basically mortgage insurance is just protecting the lender's interest should you default on the home or just not be able to pay for whatever reason. The mortgage insurance comes in and guarantees a certain percentage of the loan for the lender. All right, so finding a real estate agent. Once you're pre-approved, you know what you need for down payment, you know what you need for your closing costs. You've got to find a realtor. They're going to take you out, help you find a home. They're kind of your best resource for finding a home. They're going to come in and negotiate the purchase price and all the terms for you, the closing date, all sorts of stuff. And there's a lot to consider that a lot of times you might not even think about when you're buying a home. Appliances and all sorts of things. So you want to have a good realtor who knows what they're doing. There's different ways to find a realtor. Some people don't want to use a realtor, but I highly suggest it. If you go online to Zillow, or you're looking at Redfin, or you're looking at Realtor.com, those are good resources to kind of just give you an idea of what the market's maybe looking like, what are homes going for, what's the square footage, bedroom count, those kind of things, But the problem with that is a lot of times you'll look at, maybe one of those properties, and then you'll say, I want to buy this home. And when you show it to your realtor, that home already sold or is already under contract. Because a lot of times the data on those websites isn't up to date. So you want to keep that in mind, So to find a good realtor, you can ask your loan officer. A lot of us, we've been working for a long time. We have relationships with realtors that we've worked with, that the credit unions work with, that we can recommend. But it's also good to check for other referrals from, family. Who did your parents use to buy their home? What about any siblings, anything like that? Friends you might have at work, who are they using? You can find agents that are familiar with the area you're in, or perhaps the type of home you're looking for. Some realtors specialize in certain type of properties or certain areas. So you'll see, those kind of things. A lot of times you'll get, a solicitation from them, flyers, and you'll see billboards, so you can get an idea, and you can comparison shop. A lot of times with realtors, their fees are traditionally paid for by the seller of the home. So you don't have to really worry about paying for your realtor, because a lot of people are like, oh, I don't want to use a realtor to help me save money. And it doesn't really help you too much because the seller's paying for that anyway. So it's good to have someone who's looking out for your interests. And that's when we come to our next bullet point here. Avoid using the seller's agent, right? You might drive around when you're pre-approved just to get an idea of, what's in the neighborhood or what area you like. You might see a for sale sign and you're like, hey, we like that house. Let's call the realtor that's listed on that, on that sign. But you have to keep in mind that realtor already has a contractual obligation, or we might call it a fiduciary obligation, to represent the seller. So if he's doing double agency and he's, representing you as well, you have to wonder, is he really looking out for your best interest in those scenarios? And not that, it can't be achieved, but it does present somewhat of a conflict of interest there. So you want to keep that in mind. And when we talk about, comparison shopping for a realtor, a lot of times, sometimes it's just personality. Does my personality click well with this other person? So you want to make sure you get along and those kind of things. All right. So when you're looking for a home, right, it's easy to kind of get up on, get caught up on, you want this, a lavish home or a large home, or you want a home with all the, cosmetic upgrades or all those kind of things. But you have to keep in mind what is affordable, right? First bullet point here, it's hard to enjoy a house if you can't pay the mortgage. So number one, can you afford it? That's where the lender's going to come in. Sometimes people get upset with us because maybe they want to buy a home of a certain size or a certain amount or in a certain area, and maybe it's a little bit out of their price range. We're not trying to be mean. We're trying to not set them up for failure. We're trying to make sure that when you buy this home, you're going to be able to afford it. You're going to be comfortable in it. It's a home that, if you have a family, your family can be comfortable in it, they can grow in it, all those kind of things. We want to set you up for success. So you want to keep that in mind. One of the things we talk about a lot in the mortgage industry is that you don't want to be house poor, and you have to consider what your lifestyle is. So this is where creating a budget to see what you can afford coming into, because we say this a lot. I say this all the time. There's a difference between what I can qualify you for and what you actually want to pay. If I can put you in a house that's $1 million, do you really want that? Is that what you want for your budget? It's a question that you have to consider. What's your lifestyle like? Do you like to go on vacations frequently? How many times a year? Are they lavish vacations? Are you going to, foreign countries? Are you going to Europe? Are you going to Thailand? Those kind of things. Just what kind of lifestyle are you looking to live? What about date nights? You still want to be able to go out, maybe with your significant other, maybe with your buddies on the weekend, whatever it might be. Do you like to eat out? Are you a foodie? Do you like to go to a lot of restaurants or eat out for lunch? You have to consider what's your lifestyle, because you don't want your house payment to make you miserable, right? So those are all the things you have to look at. Consider what makes you happy and what kind of a home would it take to make you happy, right? So when you look at the home, you want to calculate all the costs, right? So we talked about loan payment. We talked about property taxes, insurance, PMI. But what about maintenance, right? If you've been renting a house for a long time, this could be all new to you. Before, something breaks in your rental, you call the landlord, they come over, they fix it, problem solved. Now something breaks, it's on you. So you want to also budget that into, your finances. What if your water heater breaks? What if the air conditioner goes out? Especially in the summer here, it could be miserable, right? You can't get someone over fast enough, and that always comes with a premium. They charge you extra to come over right away, right? Plumbing, all that stuff, landscaping, if you have a pool, are you going to maintain it? Are you going to maintain the landscaping? Those are all the kind of things you have to think about and budget for when you're buying a house. Homeowners Association dues is another consideration, depending on the type of property you get. For example, if you buy a condo or a townhome, the Homeowners Association dues a lot of times cover some miscellaneous items. They might cover your water. They might cover garbage pickup, things like that maybe you weren't, aren't covered in a regular house, but maybe, you didn't have to worry about where you were renting because it was all included in the rent. So things like that to think about, that's basically it for that one. All right. So you're looking for the house. Right, you worked up your budget. You've thought about what's affordable, what works good for you. Now, what kind of house do you want, right? Because there's more to a house than just having a place to live in. You want what you want. How many bedrooms do you need? How many bathrooms do you want? Do you want two? Do you want a two-story house? Do you want a one-story house? Do you want a bedroom located downstairs? Maybe you have an elderly parent you're considering, and you want them to have a bedroom downstairs if they come to visit, or maybe they just need help and they're living with you, So all sorts of things to consider. And these are things you'll tell to your realtor when they're out looking. They'll plug that into their system, and that'll help them find the house you want, right? What's the condition in? Is everything, brand new, or does it need a little bit of work, And if it does need a little bit of work, are you handy? Can you do some of that work yourself and get some what we call sweat equity? Essentially, you go in, do a lot of repairs on your own, and now the house goes up in value because you fixed everything, right? What about square footage? How big does you want it to be? Besides bedroom count, bathroom count, overall, you want to consider what kind of size of the house you want. Garage spaces. Does it have a garage? All of those things, right? Type and style of a home. Is it a ranch home? Is it a two-story like we talked about? Is it a townhome or a condo? What's the layout? Like I said, do you want a bedroom downstairs? Do you want a formal living room and a formal dining room, or do you prefer, a great room where everything's just kind of all spaced together, right? What's the outdoor space look like? Do you want a large yard? Do you want, do you not want a yard because you don't want to deal with the maintenance, right? And the last one, of course, location, right? In real estate, we always say it's all about location, 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 right? So where do you want to be? Close to work, close to family. What about a school zone for your kids? Maybe you want your children to go to a particular school. All considerations you want to look at. And when you talk to your realtor, you can tell them all this, and they'll actually customize your search to find what you want. All right, types of homes, right? So what types of homes are there? There's all sorts of types, right? There's some that aren't even on this list, so we'll go over it, right? Single family residence is listed there. That's basically your average home, right? Specifically, if we want to get technical, that would be a home without an association, right? But down below, you see where they list planned unit development. A lot of times for short, we'll use the acronym PUD for that, PUD, right? That's basically a home in an association. That's the only real difference there, and that's what that means. Of course, the association is usually gonna have some fees every month. They're also gonna have some rules on what you can and you can't do, but they also maintain some of the common areas. They can be good and bad. Sometimes, often what I'll say is that the theory behind associations is great, but sometimes the execution is a little lacking. They can help to maintain property values because they make sure that no one is, leaving junk in front of their homes or painting their homes odd colors or doing odd renovations that, can be an eyesore or whatever that might be. But at the same time, sometimes they can be heavy-handed. Maybe you want to work on a car in your garage and they don't allow that. Or maybe you want to have a gym in your garage and they won't allow that. They don't want the garage door to be open. There's all sorts of little odd rules some of them have, and you've got to watch out for. In my own home, one time I put a swing set up in the backyard for my children. You couldn't see it from the front yard. You couldn't see it if you looked down the side of the yard. I kind of positioned it exactly where it really wouldn't be visible. And yet I still got a notification from the HOA that I needed to, submit some paperwork to have approval for the swing set or whatever it might be, which, everyone filled out and it was fine, but it's just the headache of going through that, right? Now, the second bullet point here, duplex, multi-unit, buildings, right? What we're talking about here is duplex, triplexes, and fourplexes, right? I think a lot of people overlook this. You don't think about it, they're not too common in the Las Vegas area, but we do have some. And they can be a benefit, especially to anyone who's maybe having trouble with debt to income ratio, right? If you buy a duplex or a triplex or a fourplex, you have to occupy one of the units, but the other unit you can rent. And that rent can help you qualify for the home. And a lot of times if you buy one of these, it already has a tenant that's just going to transfer to the new buyer. And so you'll just start getting that rent, and so that's a good way to start, with home ownership or whatnot. I've told my son, I go, when you go off to college, we're going to, instead of, living in the dorm, we're going to buy you a fourplex. And that's where you'll live and you can rent out the other 3 units. And that'll be your spending money while you're in college, and that way you don't have, hopefully you don't have to work and you can focus on your studies. But definitely a good way to go about acquiring a home. And then later, you can always, you can keep it, you can sell it. But if you keep it, you can count that rental income now towards buying another property. So that's something to keep in mind if you're, interested in, buying investment properties or developing a portfolio of investment, properties that can help supplement your income. That's a good way to go about it. You can do it with single family residences. You can do it with almost any one of these properties, So the other types of properties we have are condominiums, right? Condominiums, they're usually, multiple units in a building. Sometimes they can be hard to tell what's a condominium or what's a townhouse. For example, I have a townhouse. Looks like a townhouse. It's 2-story. It has a little yard. It has a garage, a 2-car garage and everything. But technically, it's a condo. Condos, they're a little bit different in the way that you don't own anything that's from the paint out. So everything paint in on the inside is your ownership. But the land it sits on, the exterior walls, the roof, all that belongs to the HOA. And so that's kind of how condos work. They can be a little bit tricky to finance. Condos have special rules for all the agencies. Conventional loans, Fannie Mae, Freddie Mac, FHA, VA, they all have special rules. FHA and VA even have a list that basically say, these condos are eligible, and if it's not on this list, then you can't get it. So there's things like that. There are special loans for condos that are what they call non-warrantable, that they don't meet the requirements for the government guidelines. But those loans a lot of times come with higher interest rates and higher closing costs. So it's things to be aware of like that. Townhomes, a lot like condos, except you own the land, you own the walls, you kind of have co-ownership of the property. So that's kind of the big difference. You have the HOA there. the HOA on condos and townhomes is usually higher. So it's something to keep in mind when you're out looking. Sometimes people will say, I don't want anything too expensive. I don't make too much. I don't want my debt to income ratio to be too high. So they'll start looking at townhome and condos. But a lot of townhome and condos have HOAs that start at $150 or $200 a month, and those can go up as well. My condo, the HOA was like $125 when I bought it in 2001. Right now it's $275 a month. So it kind of shows you how they can increase over time and those kind of things. So we want to keep that in mind when you're looking. And since they have such high HOA dues, sometimes you're better off going with a single family residence, because if you can find one with a low association or no association, that gives you more purchasing power to go towards the house, right? And the last type of property that we have here is co-ops, right? Cooperatives. Not very common around here. You'll see a lot of these, back east, New York especially. Essentially, what you do is you buy shares in the corporation that owns the condo, and that gives you the ability to live in one of the units, right? But you don't own that unit. You own shares in the co-op, and usually co-ops are a little bit cheaper than condos. Condos tend to be a little bit cheaper than townhomes because they're hard to finance. So condos are they're usually a little bit cheaper there. But co-ops usually do require large down payments, and you have to get approval from the co-op board. All right, so the home search, right? The real estate agent can look up the homes on the MLS. We kind of talked about that. That's a special, directory they have that lets them look up homes for your criteria, what you're looking for. They can look by zip code. They can look by all sorts of things. They can even just draw a shape on the map. They could draw a star shape, and that's homes in that star shape will pop up if that's what you want. When you're out looking for homes, you're going to see a bunch of homes. You might find something that you want right out of the gate, but you might also be looking for months. It just depends on what you're looking for, what kind of rush you're in too. So when you're out looking at homes, take pictures. It can be hard when you see, 5, 10, 20 homes to remember which home had what, which one had those floors you liked, or which one had those countertops, or which one had that really nice backyard, all sorts of things like that. So it helps to remember, fill out a checklist, what has what. This is when you'll start to know that even though you may have had a needs list for what you were looking for in a house, maybe you wanted, 4-bedroom house, 2-story with a pool and a 3-car garage or whatever, you're going to start to realize that there's give and take. You might not be able to get exactly what you want, but you can probably get pretty close. It's kind of like that Rolling Stone song, right? You can't always get what you want. And so from there, you're going to look at you want to avoid being distracted by things that are easy to change. You'll walk into a home, maybe it has everything you want, but it's got old, the countertops haven't been upgraded since, 1993 or whatnot. It's got ceramic tile countertops, right? Relatively easy fix. You can hire someone to come in, just depending how intensive you want to go with your upgrade. You can get those countertops replaced, flooring or paint. Some of those things are pretty easy, even cabinets, depending on what degree do you want to go to. Those things are easy to change. So keep in mind some of the important things that are important to you, and you'll have a hierarchy of whatever that might be. Perhaps you absolutely have to have X amount of rooms, or a garage of an X amount of size, or it has to be zoned for this particular school district. Whatever that list is, you'll know, right? But don't let little minor things get caught up in that, You'll want to visit the home more than once before making an offer. And a lot of times as you start to narrow down your search and maybe, you're whittling down everything, you want to go back and look at the homes that you're really considering, right? Maybe during rush hour, there's a lot of traffic by the house, right? You won't know that if you went in the morning or if you went later at night in the evening. So you want to take those things into consideration. Is it in a flight path? And maybe at a certain time of day, there's a lot of planes flying by. You might not like that, right? So you want to know, when the neighbors are home, are they noisy? Is there a guy working on his motorcycle outside that's revving it into the late hours? Those are all things you want to know. And stopping by the house to kind of get an idea, will give you that impression. It'll let you, give you more information to make sure that's the house you want, right? And then researching the homeowners association. So this is a big one, right? You want to know what the HOA allows, what they don't allow. when you go into contract, right, and we'll talk about this a little bit later, there's contingency periods. And one of them is the due diligence period. Usually, again, it's negotiated with the buyer and the seller and your agents and everything. But when you submit it, you're going to say, we need due diligence of about 10 days or so, 14 days, whatever you guys decide it might be. That's going to be the time that you're going to get this HOA information. They're going to send you what they call the CC and Rs, which is all the rules for the HOA. It's usually like a phone book size thing, but a lot of times they have a breakdown of some of the basic simple rules, and it'll give you an idea of what you can and you can't do to make sure that you like maybe you run a at-home daycare, right? And that's a little side job that you have or whatever it might be there. Some HOAs will be okay with that. Other HOAs might not be. And if that's part of your income, you want to make sure that they allow that before you move into the home. So things to consider, right? And during that due diligence period, you have the time to do that, get your mechanical inspection of the property, get the appraisal done, make sure all that checks out. But you can get some of this information prior to making the offer on the home if you want. Just ask your realtor, like, hey, can we find out about the HOA? They can provide all that if you want to do that before you go into contract. All right, components of your offer. So when you actually make the offer on a house, you want to, there's a bunch of different things that make up the offer, right? It's a standard form that gets filled out by the realtors. They usually almost all include the same information, right? But what's the purchase price? Like, what, let's get down to brass tacks. What am I paying for this house, right? So you'll make an offer, which is your purchase price. When are we closing? Traditionally, you're looking at about 30 days out on a purchase is how long it takes to close, right? How long is the offer good for? So when you make your offer, the seller may have, depending on the market, they might have a handful of offers, or they might have 10 or 20 if the market's hot, So, it's going to take them time to look through those offers and decide which one they want to go with. Do they want a calendar? So you usually give them a timeline. We want a response in 24 hours, or we're going to give you till, a couple of days to respond back to us, right? Concessions, right? So this is when we were talking about cost the seller can pay for you. Concessions is basically cost the seller can pay for you, right? So, closing costs they can pay, HOA dues they can pay, but they can't pay your down payment. So if there's excess costs or whatnot, we talked about using that to buy down the interest rate, or you can sometimes even prepay taxes and insurance or HOA, those kind of things. But any excess funds can't be applied to the down payment. That's got to come from you or a family gift or some sort of down payment assistance program or grant that's out there, right? Inclusions is what the seller leaves, right? Now, there's a lot of things that are kind of customary to be left. They're not an issue. Appliances, right? Most people leave the fridge, the washer, dryer, the dishwasher, microwave even. A lot of that stuff gets left behind. It's pretty customary and standard that those get left. Sometimes, though, someone likes the refrigerator or they just bought it, so they take it with them. That's all negotiable. It just depends on what you guys negotiate with your realtor and the seller, However, there are issues sometimes that we see that sometimes when you're making the offer, a buyer might ask the seller to leave a pool table or leave a big screen TV or furniture or whatever it might be. That's not allowed. So you can't do that. You want to make sure that, that's not in your offer because it's going to be a problem. They won't allow that to happen. It's called an inducement to sell. So if it's an issue, you can't have any of that stuff, right? And then we come to the contingencies that we're talking about. And you have, your kind of big three contingencies. You have your home inspection, which is your mechanical inspection. This isn't something that the lender or the mortgage company requires. You don't have to get a home inspection, but we highly recommend it. They don't cost too much, a couple $100, depending on the home inspector you get. But they're going to go over there. They're going to go over the house with a fine-tooth comb, and they really will. They take pictures of everything. You get a massive report back. They're going to look at the plumbing, the electrical, the air conditioning units, the roof. They get up on the roof. Sometimes they use a drone now, so that's kind of cool. But they'll get into the attic. They'll do all that kind of thing. They'll look under the sinks. They'll put, they'll turn on every faucet. They turn on the ranges on the stove to make sure they're working. The oven. They look at everything. So it's really handy to have your financing contingency. This one's usually a bit longer. If you have a 30-day close, a lot of times you're looking at a financing contingency of about 21 days, usually 3 weeks or so. And basically what this is kind of the point of no return, right? It's at this point, your loan has to be approved by the underwriter, or you can't drop out of the deal if you don't get the loan after that. So it's things you want to consider. A lot of times that's all kind of done and taken care of. And if you were pre-approved properly by your loan officer at the beginning of the loan, you'll be fine, right? And then the appraisal, which we spoke about. The appraisal is going to check to make sure the house is worth what it's worth. All right, so making an offer, right? Your real estate agent is going to present your offer to the seller. Seller may not accept it. They may come back and counter. You might offer 400,000, and they might come back and say 420. It just depends. But you'll go back and forth, and that's the way it goes. You'll ask for closing costs. It's just negotiation, right? Now, here it says it's customary to give an earnest money deposit with your offer. So that's basically letting the seller know that you're serious about buying, the house. So the agent's going to present your pre-approval letter that says you already took the time. You presented your lender with all the, documents that you needed. They pulled credit. They looked at your application. And here's a deposit showing you that I'm serious about wanting to buy this house, right? Here it states, it's usually between 1% to 3% of the purchase price. That's a little bit high. Usually you might be looking at, depending on the house, of course, in the market, anywhere between $1,000 to $5,000 for your earnest money deposit. Now, that's not an extra cost. Sometimes people think like, oh no, I have closing costs on my down payment and I have to make an earnest money deposit. That's not an extra cost. That goes towards your total closing. So if your down payment and your closing costs and everything end up being, $20,000, right? If you gave the buyer a $5,000 earnest money deposit, now at the end, you're only going to need $15,000. So it's not like it's an added expense, but it's something you want to keep in mind that you're going to have to come up with when you're making your offer. And like I said, it could be $1,000, $2,000. Just depends, But a lot of times, the bigger your earnest money deposit, the more serious the seller knows that you are about buying a home. I was looking to buy a home about a year ago for my mom. It was like 2 houses down. She's getting older, and she lives by herself. So I was like, let me buy this house and she can live in it. And and it's great. And it was 2 houses away, a little 1-story house. It's perfect for her. And I knew the neighbors, and we made them an offer. And they already had an offer on the house because we didn't know it was for sale. They had listed it off market. And it turned out that the buyer that had made them an offer gave them an $85,000 earnest money deposit. So they went with that offer, and because obviously that buyer was pretty serious about getting the home. So there's just things to think about, right? Now, you're not going to give that earnest money deposit directly to the seller, right? You're not going to give it to the seller's realtor. You're not going to give it to your realtor, right? It gets made to the escrow company, and the escrow company is going to hold those funds for you. So they're going to make sure that no one, uses those funds, beforehand, or that nothing happens, or the funds disappear. That's what they're there for, right? In the past, a lot of escrow companies, title companies, will let you they would let you give them a cashier's check. But that's kind of gone away. A lot of them now want you to wire those funds to them. So those are one of them you'll have to do, right? You make your offer, you give them the EMD, you give them your pre-approval letter. The seller's either going to accept, reject, or counter, right? So that's what, those are all. If they accept it, great. Now we start working on your loan. If they reject it, back to looking for a house, right? Go to your second favorite at that point. Once the offer is accepted, now you're in a binding contract. You both are now obligated to close. Except for if you do your inspections during that due diligence period. If, you find something you don't like, you can back out at that point. But once you kind of pass that, it's the idea that you're both moving forward in good faith to buy this house. All right. The pre-closing period, or what we refer to as the escrow period. Sometimes people get confused because you'll hear us talk about escrows on your mortgage payment. Your taxes and insurance are being escrowed. And then they also hear us talk about escrow. So we use those terms both ways. But pre-closing period, which is why they've used pre-closing period here, is basically the point from when they accept your offer to the point where we close. So at this point, you're going to have your home inspection done. They're going to look at it, make sure everything's okay. They're going to notify and periodic, you want to notify and periodically check in with the lender. So you're going to, check in with your mortgage officer, make sure everything's okay. The mortgage officer is going to have an assistant called a processor. A lot of times they'll reach out to you. You can reach out to them, talk about, any concerns you might have, any questions you might have. You'll get notified when you get the appraisal and other things like that. get homeowners insurance, you're going to want to shop around for who you're going to use for your homeowners insurance. You can pick anyone you like. You don't have to go with whoever the mortgage company picks. A lot of people start with whoever insures their automobile. So if you're with Allstate or Geico or State Farm, whose ever good hands you're in, you can stay with them. It's fine by us. We're kind of indifferent, You might ask for suggestions, and we can refer a couple companies to you and give you a couple quotes or whatnot. But shop around. The lower your insurance premium is, the lower your house payment will be. So, it's all stuff to consider. But sometimes you have, certain coverages you want. Avoid taking on any additional debt. Now, this is big. Once you're in contract, everything's rolling ahead, right? You don't want to go out and buy, anything new, right? Don't go out and make any major purchases. Don't buy a car at this point. We see that a lot. A lot of times people will go and, they'll be at a furniture store or they'll be at an appliance store, whatever it might be, and they'll see that they're running a special or a promotion that has, no interest and no payments until, 2030 or the end of time or whatever it might be, right? The problem with that is a lot of people think like, hey, it's got no payments, so I can buy this. Well, we still have to factor in that payment because you're doing a 30-year loan, and that probably doesn't have, a no payment deal for 30 years. So we know that at some point you're going to have to make the payment on that furniture or those appliances that you bought while you're also making the payment on the house. So all of a sudden we have to factor that in, and that can disqualify you. So make sure you're not making any purchases like that during the process. Once you're closed, you can go do all that. You can, go get furniture, go get the appliances, whatever you want to do. But don't do that during the transaction. Try to avoid making all that. We also suggest, that you wait before making any of the major milestone movements. So if you're renting, don't go and put in your 30-day notice just yet, because anything can happen. And I've seen it all in the 20-some years I've been doing mortgages. I've seen it all happen. Sometimes you're getting ready for closing, and there's been a pipe that burst in a bathroom, and now there's a leak, and now that leak has to get fixed. And that takes maybe an extra 2 weeks, but you already told your landlord you were going to be out at the end of the month, and now you've got nowhere to go because he's already rented out your apartment or your house that you were renting to somebody else. So you want to keep that stuff in mind. Traditionally, we'll say, check with your loan officer when's a good time to put in your, 30-day notice to your current rental. For the most part, I usually, suggest like the week before closing or so, and wait till then because you're going to skip a payment anyway. So you're going to have time. You won't be making, both payments on the old rental and this, and it gives you time to kind of leisurely move out of your previous home, fix everything you might need to fix so you get all your deposit back, all that stuff, right? But it also doesn't cause extra stress because there's nothing worse than, oh no, we were supposed to close and now something's happened and we're not ready to close and now we don't have anywhere to be. So don't make plans for furniture to be delivered or for movers or any of that stuff until you kind of get the all clear from your lender. Don't change jobs. We talked about that a little bit earlier. Those are all the kind of things to avoid doing while you're in this pre-closing period, right? So one of the things that's going to come up is how do you want to take title, right? If you're buying a house by yourself, then at that point, usually you're buying the home just as a, sole owner. A lot of times it might be, John Smith, single man, and that's how it's vested, or, Mary Jane, single woman, married woman still in separate property. It just depends how you're doing it if you're buying it by yourself, right? But if you got more borrowers, there are various ways that you can hold title. Tenancy by entirety isn't too common. It's only for married couples. It basically allows, full ownership of the property by either party. It's not very common. You still need signatures from the other party to sell. This also gets a little bit murky because Nevada is a community property state. So you have to keep those things in mind, with some of this. Then you have joint tenancy. That's the most common one we see. Joint tenancy usually just means that you're both going to be on title. You're both equal owners. And should one of you pass away or, anything happen, the ownership transfers to the remaining person on title, and they are now full owner of that property. That's how most people take title. The next one, tenancy in common, kind of comes up with specific situations. And sometimes what you see with tenancy in common is perhaps you have like a blended family. You have maybe a husband and wife. They were previously married. They have children from their previous marriage. They now get, married. They buy a home together. But they don't want all the ownership in the house to pass to the surviving spouse should they pass away. They want it to pass to, their children. And that's what Tennessee in Common you can do. You can designate who you want that to pass through. And then at the very end, you want to do a final walkthrough because like I talked about, all sorts of things can happen. You can, you can have pipe bursts. You can have, squatters pop into the house. You can have all sorts of things can happen. So you want to do that final walkthrough, make sure that the previous owner didn't damage anything when they were moving out. There was no, vandalism caused by anyone while the house was empty, those kind of things. All right, closing. So now it's time to wrap everything up. You're getting ready to close. Your mortgage is finalized. The title of the home transfers for you. Traditionally, before closing, you're going to get what's called a closing disclosure. It's very similar to that loan estimate that I mentioned earlier. It basically lets you compare how the loan started with that initial loan estimate and how the loan is ending. And almost everything's going to be the same. You might, like I said, you might have a few changes with taxes and insurance and the days of interest, but everything should pretty much be the same, right? If actual costs vary by a ton, you'll want to find out why. What happened? Did something change? Did my credit score change? Did something happen? Those kind of things, right? You'll go to title. You're going to sign a giant stack of documents. Your hand's going to get tired from signing everything. You're going to sign the note, the deed of trust. There'll be another closing disclosure at title, which basically just has more accurate number of days of closing because now that we know exactly what day it is, they're going to update some of that stuff and whatever affidavits might need to be signed, right? Now, you're not done yet, though. You go, you sign everything. Traditionally, your loan is going to fund the following day. Sometimes it can fund the same day, but traditionally, it's the following day. And what you want to watch out for here is being careful because a lot of people go sign and they think that's it. We're done. Everything's great. I got my house. Everything's great. It's not done until you get your keys, right? The loan has to record. The loan has to fund. Right before closing, we're required as a lender to do two things, right? We're going to do what's called a credit refresh. We're going to go in. We're going to pull like a soft hit on your credit. It doesn't really pop up, but all it's doing is checking for has there been any increase or decrease in your balances on your credit cards, your payments, whatever. Did your payments go up or down because maybe you charged a lot of stuff up on it, right? Are there any new accounts showing up that weren't showing up before? Because now we have to count that against you. Are there inquiries? Even if there's no new accounts showing up and we see inquiries by companies, it's going to raise a red flag. If we see inquiries at Honda and at Nissan and at Dodge, we're going to say, hey, were you shopping for a new car? Yes, I was shopping for a new car. Did you get a new car? Right? And of course, then that could be, a problem. So those are the kind of things we're going to look out for. The other thing we're going to do, and I had this come up once on a transaction, is we do a verbal verification of employment. We're going to call your employer and just double check that you're still working there. So wherever you might be at, we're going to pick up the phone. We're going to call. We're going to say, hey, does John still work there? Yeah, he still works there. Great. I once had a scenario where I was doing a loan. It was for a teacher. We called up, hey, does she still work there? They said, no, she quit yesterday. She signed her loan documents the day before. She thought everything was done. She quit her job, right? Because she was going to start a new career. The new career she decided to get into was a real estate agent. But she didn't know that this was part of what happens. And so we had to scramble at the last minute and try and make that loan work. And I think we ended up adding like her dad or someone on it to make up for the income that she lost because now we can no longer count that income because she quit. So that is basically everything here. I figured now we can go over some questions. Oh, we got a little bit more here. I forgot about the tax benefits of homeownership. So one of the best things about buying a house, of course, you get tax deductions. They're going to reduce your taxable income. Depends on your situation. You kind of want to talk to your accountant or your tax preparer, but you may be able to deduct, different things. The interest on, the mortgage that you're paying, the property taxes, the PMI, the mortgage insurance can even be deducted sometimes against your taxes. Points that you paid, they're handled differently depending on your situation if you're buying or refinancing, but it's a huge advantage to buying a home because now not only is a little bit of what you were paying for your housing expense actually, contributing equity and paying off the debt. So eventually you might not even have a home expense, right? But you have tax write-offs, which you don't get when you're renting. So here's my information. That's me. That's my cell phone number. If anyone has questions, you can call me, you can text me. I'm always working all the time, after hours, on the weekend. It's just kind of the nature of the work. There's my email as well. You can always email me. Everyone, like we mentioned, is going to get a copy of this presentation along with the notes that go along with it. If we have some time still, we can see if we can go over any of the questions. I'm not sure how we're doing, but we'll give that all a look here. So Joe's asking here, how much is PMI, right? PMI varies. If you're doing an FHA loan, they kind of have a set amount for PMI. They charge PMI in two ways. They charge an upfront amount that gets financed into your loan and a monthly amount. So they're kind of double dipping. With a conventional loan, it's one or the other, either upfront or monthly, right? The amount on a conventional loan that you have to pay depends on how much you put down and what your credit score looks like. And it even debt to income ratio factors into that. So there's a lot of variables that go into account for that, right? For FHA, the upfront premium is traditionally 1.75% of the loan amount. It just gets financed into the loan. And if you're doing minimum down, the monthly mortgage insurance is 0.85% of the loan amount. So they'll figure out that calculation divided by 12. That's how much you pay a month in mortgage insurance on an FHA. VA doesn't have any PMI. Instead, they have something that's called the funding fee. They think it's not the same, but it's kind of the same thing. And it can vary depending on if you've used your VA before or if you haven't. But there is also exemption from the VA funding fee if you have any service-related disability. I think traditionally, for a while, it was like you had to be at least 10% disabled. I believe right now, if you have any VA disability, they'll make it exempt. But we'll know for sure by checking your VA certificate of eligibility, which we'll get right from VA. Let me see, is there a way to see all these questions? Hold on, let me see if I can. All right, so here's some of the questions. Let me see if I can go through some of these. So Rosemary was asking, my husband and I have an other than honorable discharge from the Navy. Could we qualify for a VA loan? It's going to kind of depend on what that discharge is. So we'll have to look at it. There are times where you don't necessarily have to have an honorable discharge, but it does depend, what was the discharge and, sometimes how many years of service you had. All those things come into play. So it is a possibility, but if not VA, then we could always look at FHA or conventional. So let's see what else we have here. Sheila a little earlier asked about mortgage insurance, but I think I explained that.
There was an earlier question in the chat box from Lorena. How can you get an idea of what closing costs are so that you can save accordingly?
Sure. Yeah. So it really depends on who you're going to use for a lender, because all the lenders have different costs, right? For the credit union, and again, it can vary, and there isn't really any percentage to use. A lot of places will try and use a percentage, and they'll say like, "Oh, costs are like 3%." That can be skewed because, of course, if you're buying a house that's $1 million, you're not going to have $30,000 in closing costs, But for the most part, for the credit union, our cost range, like I said, anywhere from like $5,000 to about $6,500. That's usually right about where they're at, depending on your property taxes and the amount of interest you're going to pay. If you opt to pay any points, those things, then points can come in and make those costs higher. But for the most part, with us, 5 to about 6.5 is usually a pretty safe bet. And if you really want a kind of more concrete idea, to get together with a loan officer, kind of go over the situation, they can put together, for your situation, what those costs might be looking like.
2 more questions from Nick. Is there a maximum gift amount? Is there a limit? And how does a bankruptcy affect your chances for getting a mortgage?
Okay, good question. Good questions, right? So gifts, right? There is no maximum amount. So, you could be buying a house for $300,000 and get a $299,000 gift. You don't really need a loan at that point, but you know what I mean? But you can get as big of a gift as someone will give you, and we will accept it. So there isn't any problem at all there. There's even times where, perhaps you're buying a home from a family member and the home might have some equity built into it. and perhaps the family member wants to gift you that equity, and we can do that. We can use that like a 20% down or whatever that percentage might be. They can give you a gift of equity, and essentially no money is really changing hands there, but it's a way to buy a home using a gift or a gift of equity. And then the other question was about a bankruptcy, right? The different government agencies have different guidelines for bankruptcy, foreclosure, short sale, those kind of things, right? So on an FHA loan, if you had a bankruptcy, you only have to wait 2 years. So 2 years after the date it was discharged. So they go by the date it was discharged, not the date that you filed. So that's important to remember, because every now and then people will say like, "Oh, I did my bankruptcy in 2000, 18, right?" But they're going by the file date. It didn't get discharged maybe until 2021, and so that could create a hurdle. Now, if you're doing a conventional loan, a little bit longer there. You have to wait 4 years from a bankruptcy to be able to qualify, right? VA traditionally follows the FHA guide. So if FHA say 2 years, VA will usually go by that. There are a few caveats, right? On a conventional loan, if we can show that the bankruptcy was due to some, out of the ordinary cause, right? For example, they will even consider divorce to be like, a cause that's out of your hands, right? They will allow the wait period to only be 2 years. And if we can show that perhaps there was a decline of income of about 20%, that's also, maybe because of economic, issues like the housing recession, where we had a lot of people laid off or they were furloughed or their incomes were cut. They'll cut that down to 2 years in those cases.
Another question regarding, sorry, Ryan, there's another earlier one from about student loan forgiveness. Do they need to wait until that's been dissolved, or can the bank or credit union take that into consideration when they're approving the loan?
There's not a ton of guidelines out just yet on the, dissolving of the 20,000 I think they're talking about for student loans. So at this point, I think, we're on the safer bet waiting until some of that has been resolved. However, when it comes to student loans, depending on the type of loan you're doing, if you already have an income-based repayment plan in place, when it comes to qualifying you with that, we can go by whatever the payment that's showing on that income-based repayment plan for a conventional loan. FHA is a little bit different, you know what I mean, depending on what it is. But on a conventional loan, if that income-based repayment plan even shows a zero payment, we can actually use zero to qualify you. But we have to make sure how long the payment, the payment plan is going to be in place and all that criteria. You know what I mean? So I think once, we get a little bit closer to the, the student loan debt being dissolved, we'll start to get more updates on those guidelines and how they're going to handle that. I do know some states were considering, of course, we don't have to worry about that here because, we don't have state income tax, but I know some states were going to consider actually some sort of tax penalty for the forgiveness of that debt.
Wonderful. Another question from Ms. Diane. I believe this was in regards to the 2% down program. She asked if that could be used in combination with the Teacher Next Door program.
It cannot. So the 2% down program is it can't be used in combination with that because the way the Teacher Next Door program works. Well, let's see. Just to be clear, was this Teacher Next Door or is this the Home is Possible teacher program? So if you can put that in there, let me know. But I'll kind of cover both. Teacher Next Door is a different program. It's kind of an older program. They don't call it that too much anymore. They refer to it now. I think it's the Good Neighbor Next Door program. Teacher Next Door is kind of we don't see it too much anymore, but it was a pretty popular program. Basically, the Teacher Next Door lets you buy a home that was already owned by HUD at a discounted rate. So I'd have to double check, but I think as long as the home met all the criteria for our program, that you possibly could. So we might have to just double check that, but because as far as I remember with the Teacher Next Door, the Police Officer Next Door program, it was just a home at a discounted rate, so it was pretty good. The Teacher Next Door is only a program for like HUD-owned homes. You can't use that to buy a new home. You might be thinking of the Home is Possible program that has a teacher variation. And that program can't be combined with our Home Now program because there are two separate programs. The Teacher Next Door, sorry, the Home Response program, or the teacher variation, is a program from the state, and the state sets the rates and the terms for that program, and the loan actually ends up being owned by the state. So we can't go in and use our Home Now program with the state's program because it's different. You know what I mean? They're not actually, giving you those funds or whatnot. It's a little bit different program. Yeah, I do believe that they said that the recording, Romana just asked if the recording of this class is going to be shared with us. I do think the presentation is going to be shared. Brittany, I don't know if you know of exactly, or Crystal, if that.
It'll be tomorrow. Tomorrow, the presentation will be shared along with notes of the presentation. So all of the additional information that Ryan shared that wasn't on the slides, you will get that as well as the recording. And information about the down payment assistance program. All right, and then going back to the chat box, there was another question from Angela. She asked, on an interest-only mortgage, does one need to refinance to start paying on the principal?
No, you don't need to refinance to start paying on the principal. You can start paying on the principal out of the gate. So, the interest-only payment is just the minimum that's required every month. But you can always pay additional principal. And then once your interest-only period is over, they will automatically start making you pay principal. So there isn't anything you have to do. Now, of course, if you want to get out of the loan before it starts to adjust, or before the loan re-amortizes at a shorter term, making your payment go higher, then you can always refinance. You just have to be cautious of the lender putting in any repayment penalty or anything like that. Some lenders that would do those type of loans sometimes would say, oh, it's a 3-year, ARM, or 3 year interest only, but you have to stay in the loan for at least 3 years or X amount of time, so that if you could try to get out of it, you'd still have to pay a penalty to them. So just be wary of that. That information will be on your loan estimate. So if you're getting that type of loan, an ARM or whatever it might be, when you get your loan estimate, like on the third page, I believe, is a section where it talks about, does this loan have a prepayment penalty feature? And you can just double check that they're not trying to pull a fast one on you or be sneaky,
Right. From Engelbert, he says, hi, Ryan. How low mortgage interest rates can you get with excellent credit score with 10 or 20% down payment? Thanks.
Again, it just depends on the market and, the type of loan. Or, FHA traditionally has a lower interest rate than conventional. VA sometimes tends to be lower than both of those. Our Home Now program is probably the lowest rate you get right now. So if you were eligible for that, I'd probably lean towards that program. But it just kind of depends on your situation. So we would have to sit down, plug in all the pricing criteria, and the rates can fluctuate daily. Not only can they fluctuate daily, sometimes, the rate might be one thing in the morning, and later that day, the rate has changed. And it's just tied to the markets and what's going on. For example, on 9/11, I remember working that day. I think there was, the markets were scrambling because everything was happening and it was kind of chaos. And I think there was like 5 different, market rate changes that day, and because everything was kind of going, crazy. So it just depends, when we look at it. But if you have questions, feel free to give us a call. We can plug all that information in for your particular scenario, price that out for you so you know.
And this kind of leads to the next question from Nick. He asked, how far in advance should you start the process, getting a pre-approval or getting a pre-approved letter?
I say there is never a bad time to buy a house, right? And like I said, I'm a big proponent of home ownership. In the 20 years that I've been doing this, I don't think it's ever been a bad market. When people say, "Oh, is the market good? Is the market bad?" If you're thinking of maybe you're not quite ready, maybe you don't have the assets yet, maybe your credit needs some work, maybe you need to pay off some things so your debt to income ratio is where you want it to be. You may never know those things unless you apply. So it's you might be 3 months away, 6 months away, a year out before you're thinking about buying a house. I say go ahead, get together with a loan officer, apply. You know what I mean? You're going to take a little hit in your score for the credit ding. It might be like 5 points, but it's worth knowing because then the loan officer can kind of set you on the right track. So you're not trying to guess at what you think you need to focus on. You don't want to spend a lot of time saying like, "Oh, I'm going to pay off all this debt," where maybe instead what you needed to focus on was putting money together for savings for a down payment. But if you paid off all that debt, now there's nothing you can do. You know what I mean? Now you're like, oh no, I paid off all that debt. I don't have any extra money for down payment. So this is where you want to talk to your loan officer, because they can identify what the strengths and weaknesses are of your particular situation, and set you on that path.
And a question from Cody. They ask, is the 81,700 income limit for first-time home buyers per person or the total amount for people buying the home?
It is the total amount for people buying the home. So it's the total income used to qualify, or we might refer to it as qualifying income. So if you have two people on the loan and they both make 40,000, you're under that limit. But if you have two people on the loan and one is at 70 and the other one's at 50, you're over. So you want to make sure that the total income of the people that are on the application are 81,700 or less, right? Now, the HUD adjusts that figure every so often, every year. I think they usually adjust it in the springtime, you know what I mean? So we might be getting an update on that, as we come into like March or April. But when we do, we'll adjust the program accordingly so people know. But like I said, if maybe one borrower is under that figure, then we can look at qualifying just that person and seeing if they can qualify for the payment on their own, which sometimes is possible if maybe the debt is loaded more on the other person, or, just those kind of scenarios. So.
Right. And then Ramanda asked about a repeating of tonight's webinar. There will be a couple different things. We will be posting the seminar, the recording of it on YouTube. Also, if you would like to attend a live or another virtual showing, we'll be hosting another one in February. So just keep an eye out for those. The next question, I think you got Michaela. Nick, again, thank you. What about when you are renting? What about when you are in a renting situation? Lease is up towards end of next year.
Okay.
I'm assuming
So,
it's applying.
a couple things you can look at there, right? You could start looking now just to get an idea of, are you ready to buy? How are your finances? How does everything look? What does the payment look like? But you're going to have a lot of variables that are changing between now and then, because we don't know, of course, what home prices might look like next year. And we might not know what the interest rate is going to look like next year. They could be higher. They could be lower, with this program that we're offering right now, it may not exist in a year's time, but we might have a different program. So there's all sorts of, variables that we don't know, but it's always a good idea to kind of jump in and get an idea. Now, if you're currently renting, and this is something you'll want to check on your lease, check with your landlord, those kind of things. But a lot of times, landlords will make it look like you can't get out of your lease without, paying a huge fine or fee. If you check with your landlord, check with your lease, sometimes you can, as long as they can find someone to rent your property out right away, And if the rental market's strong, sometimes you can get out of your lease without any issues. As a matter of fact, if you kind of just float it past your landlord, just like, hey, what if we wanted to get out of this or whatnot, he might be like, hey, if you're looking to get out, that's awesome, because if you move out, I can get someone new in here and charge more rent, So it just depends. It's not, like ironclad that you have to stay in that lease for a year. So if rates are low, like we've got this killer program right now, with a 2% down and this phenomenal interest rate, it might be worth, looking into to see if you can take advantage of that now versus waiting, depending on what your scenario is looking like.
And it looks like the last question from Jamie. They ask, if there is a cosigner on the loan, does their income count towards the income limit? For example, she cosigns for her husband or vice versa.
Yes. Yeah. So any cosigners on the loan, that income is going to be counted towards that limit. So if wife goes on and husband cosigns, then there's an issue there. That wouldn't work. Now, hypothetically, right? Let's we do an odd situation. Sometimes we can have a cosigner who's going on the loan just to help maybe with credit. Maybe you have a young borrower, they don't have a lot of credit history. They can even have good credit, but sometimes if you don't have a long credit history, even if you have a 700 credit score or something, Fannie Mae or Freddie Mac might not like it, which is odd, but I've run into that. I've run into situations where a relatively young buyer didn't have a long credit history, but had like a 740 FICO, was putting 20% down, and Fannie Mae said no. They were like, they haven't had credit long enough. So there, there's situations like that. We had to switch that person into an FHA loan, and that worked. But maybe you have a borrower on there, they're under that $81,000 limit. You need someone to co-sign, just for credit purposes. Maybe you just to help out, like a weaker credit score or lack of credit history. You could have a borrower who maybe doesn't have income but has a good credit score go on there to help. But you have to keep in mind that if they have a lot of debts, then that could actually be detrimental to qualifying, because we have to factor in those debts for qualifying too. So it gets a little complicated, but there are ways to kind of go about it.
From Angela, what is the ideal income ratio to purchase?
So debt to income ratio, there's a lot of little factors that track this. For a long time. People used to say, to be comfortable, most lenders want 33% of your gross income to be for the house payment, right? But there really is no set rule, there's no rule set in concrete. For a conventional loan, traditionally the maximum debt to income ratio that they will approve is 50%. For an FHA loan, you can go to 56% at times is usually the max. That doesn't always mean, however, that if you have a 56% debt to income ratio, they're always going to approve you. Even on a conventional side, if you have a 50, it doesn't always mean you're going to get approved. VA is kind of a wild card. VA has their own special debt to income ratio that they consider, is called the residual debt to income ratio. And as long as you meet their residual, they'll allow your regular debt to income ratio to go pretty high sometimes. It just depends on the strength of the borrower, but you could have a 60 or 70% debt to income ratio. But VA, of course, trusts in their veterans, and they have a lot of measures in place to address, any delinquency and things like that. So that's why VA kind of allows some of those things. But ratio-wise, it kind of just depends on the overall quality of the file. There really is no one thing that will get you approved or denied. You kind of have to be strong in all of them. You could have a 40% DTI or a 37% DTI, and maybe for another reason not get approved. So we kind of have to look at the whole picture.
All right, I don't know if you see those, Ryan. Sheila is asking if the 2% down program allows for 50% down. And then Engelbert added on to that. So if you're locked into your mortgage rate, how long are you able to use it, and how much is locked into your mortgage rate? Thanks.
Okay. So for the 2% down program, it could depend on your FICO score, right? It can vary a little bit. We go all the way down to 620, but that can change, on what they'll allow for debt to income ratio. So it kind of depends on your situation. A lot of times if you're doing 3% down, we can go to 50%, but it's going to depend on your situation. What do your reserves look like? What does your employment history look like? Those kind of things that we're going to have to review. Traditionally, if you're doing 2% down, we want to hover around 45%, or lower. So it just depends, Now for Engelbert, you were asking, so if you locked in your mortgage rate, how long are you able to use it, and how much to lock in your mortgage rate? So I believe what you're asking, Engelbert, is if you get pre-approved, can you lock in your interest rate right then? You can't lock in your interest rate until you find a house. And that's part of the reason, is kind of due to your question here in regards to how long, right? Let's say we pre-approve you, and then we lock you in for 60 days, but it takes you 45 days to find a house or to get your offer accepted on the house you want, right? Now we're left with only 15 days to close. And that's not realistic. Traditionally, the lender's going to need approximately 30 days to get your loan closed. It's not impossible to do shorter, but on average, 30 days is a safe bet. So if you run into that situation where you lock in early, and now you've only got 15 days to close, now you're looking at extensions, you're looking at worst case pricing, and things can get bad there. You know what I mean? So there's those kind of situations. The other thing is this is the reason why we don't normally let you lock in until you find a property, and at that point we'll do whatever you might be thinking, 45-day lock, a 60-day lock. There's different term periods that we can lock it in. There isn't a cost to lock in, so when you lock in, you just kind of lock it in. There are some institutions that offer long-term locks. You know what I mean? So maybe you're buying a new home, And usually you'll see this with like the builder's lender or whatnot. They may offer like a 180-day lock, or they might offer some extended period of lock. But traditionally, the ways those work is that there's an upfront cost. Usually, some percentage, it might be like 1 point or more. It's non-refundable, so you'll pay that to lock in, and then for whatever reason you don't close on that house, they keep it. So it's just something to keep in mind if you're considering doing something along those lines.
Right, and then before we wrap it up, I just want to give anyone the opportunity who's not able to type in their question. If they would like to speak directly to Ryan, you can unmute yourself at this time and ask him directly.
Any takers? Any questions?
I just want to say thanks for doing this. Great presentation.
Sure. Thanks for attending.
Oh, Jamie snuck in a question.
It was very informative.
Okay,
Thank
so
you.
before we leave, let's see from Jamie. So with the average median home price being 350 to 400,000 in Clark County, what debt to income ratio would be needed to support the mortgage payment, including PMI?
So again, this is kind of an interesting question, and this is a question I get a lot sometimes. You know what I mean? The average median home price being this. Here in Clark County, what debt to income ratio would be needed to support the mortgage payment, including PMI? So, if you're doing a regular conventional loan, like I said, often you can go all the way to 50%. But we've got to first factor in there's a lot of variables here. So we're solving for X, Y, Z. We've got a lot of variables we're dealing with. We can, figure out what the rate might be and the term of the loan, but what are the taxes, the insurance? How much are you putting down? That's going to affect the PMI. That could also affect the interest rate you're getting. So those already are a ton of variables just to calculate what the payment might be. Then, what kind of debt to income ratio are we needing, right? Well, what are your debts? What kind of program are we going with? Are we doing an FHA? Are we doing a conventional? Are we doing a VA? Are we doing our special program? There's a lot of variables there. So in that situation, if you want to know, I'd say, give me a call. I can go over all of that with you and kind of sit down with your specific situation and kind of pencil that all out. But it's something that, sometimes I think people don't quite, they just kind of want a basic answer. And it's not so easy because there's a lot that goes into it. And we want to make sure that we give you the most accurate information when we're kind of going over all of that. One of the questions I get, a lot of times I'll have a realtor refer someone to me and they'll say like, oh, the borrower has a few questions before they apply online. I go, okay, if you have them call me, we can go over anything. They'll call me and the question is, can I afford a house for $500,000? And of course, my response is like, well, you got to apply for me to know for sure. If you have basic program questions, how much do I need down? What's the minimum I can do? What if my score is this? What can I do to bring up my score? Those are all things we can kind of go over pre-application. But a lot of times to be able to really look at your scenario and advise you best, I need to look at the whole picture. Every loan officer needs to, right? So when you're out there shopping, if you're talking to another loan officer or anything, make sure they're doing their due diligence. You don't want a pre-approval where someone hasn't reviewed your documents, where you haven't submitted an application because that pre-approval is not worth the paper that it was written on. And it can set you up for a lot of, heartache and wasted time where you're out looking for a home, you find it, you love the home, and now you can't buy it because whoever did your pre-approval didn't really do everything they were supposed to. I always kind of compare it to getting a recommendation for treatment from a doctor, right? If you go to the doctor and you go, doctor, I'm not feeling so good, what should I do, right? If all he does is take your temperature, his treatment probably, it may or may not help you, but it's kind of a shot in the dark, right? You'll want him to thoroughly assess what might be going on with you, right? How are you feeling? Do you have stomach pain? Do you have abdominal pain? Are you getting headaches? How's your vision? You want them to do a full assessment, do blood work, do all those things. That's more or less what a loan officer is doing. They're looking at all your, everything that's going to go into this loan and make sure that we're going to set you up for success.
I have a question. Can you hear me? Okay.
Yeah.
Being that we were in this pandemic for the past 2 years and people are just now starting to get back to work, how many pay stubs up do you want to be able to qualify someone that's just started back going to work?
So it does get a little tricky with the pandemic and the time off. A lot of it is going to kind of depend on how you're being paid, right? So, for example, let's say you're a salary worker, and maybe you've worked for whatever office job you might have, and you had a salary. You were they shut down. You were out of work for all of 2021, maybe all of 2020, maybe part of 2021, or even now, like some places you've just started back at. I have a gentleman, for example, that he was working for the Palms. The Palms closed. In the middle of COVID, the Palms sold to a new owner. And while a lot of the other hotels opened, this one just now is finally reopening after COVID. So in his situation, his income was variable. He had, tip income and variable hourly income. So he couldn't quite, get approved for a loan right away because the underwriter has to kind of track what the consistency of his income is going to look like now that he's back to work, right? But on the other hand, if you have a salary employee, maybe they were working that salary job before, there was a gap of employment because of COVID, but it's explainable. Now they're back at the same salary position with the same employer, and and that salary is consistent and the same. A lot of times, we have usually they want like 30 days worth of pay stubs. So if you're getting paid weekly, they want 4 pay stubs. If you're getting paid biweekly, they're going to want 3 pay stubs. Because biweekly is 14 days, and if you only have 2, that's 28 days, and they want 30. So we'll need 3 to kind of make that full 30-day window that they're looking at. But that's usually what we would look at. If it's variable income, it gets a little bit more complicated. We'll have to look at what's the nature of the income. Are you working 40 hours every pay period? Those kind of things. A lot of times if someone is hourly, if we can document on their pay stub that their year-to-date income and all those things, that all of those signifiers, show us that you're getting 40 hours, 40 every check. Then a lot of times that's how we'll calculate the income. We'll say, okay, it's X amount an hour times 40 hours a week, basically 2,080 hours a year, and divide it out, and that's what we'll come up with. But if you have one paycheck that maybe you only had 32 hours that paycheck, and you didn't have PTO to make up the shortage or whatever, all of a sudden we're forced into averaging. And so now we've got to average 2021. And of course, with the gaps in employment because of COVID, that can kind of reduce your income significantly. So it's things like that we'll have to kind of look at and assess. Even if we have pay slips that all show like 40 hours. Yes.
We're about to run out of our recording time. So if we can wrap this up
Yeah.
and then people can contact you by email or phone number.
Yeah, feel free, reach out, email me, call me, anything.
Thank you.
No problem.
Thank you, Ryan.
Excellent
Yes.
presentation.
Thank you, Ryan.
Thank you.
Thank you, Ryan.
Thank you.
All right, no problem at all. You're welcome, guys.